Today I'm talking about
what is depreciation? Depreciation is used for assets. When you buy an asset, and by what I mean by asset is when you make large purchases that can be used over multiple years, that is considered an asset. When you do this, the default rule is you have to take the expense over several years. Now, there's some certain exclusions in the tax code that allows you to immediately expense those large purchases. One of those exceptions is bonus depreciation. Bonus depreciation allows you to take a certain percentage, a big percentage of that purchase in the first year. Previously, it was 50%, but with the new tax law, that is now 100%. That could be a huge savings depending on who you're talking to and what your circumstances are. To qualify, in the past, it used to be for bonus depreciation, it had to be a new property, but now with the new law, you can actually use it for used properties too. So it's not just for new, you can actually buy a property that's already been owned by someone as long as it's not a related party, but you actually buy it used new. It's used to you, but it's new to somebody else who's not related to you. Now let's talk about Section 179. The new law also made changes to the Section 179 deduction, which is an alternative to taking bonus depreciation. The big thing about why someone might want to do bonus depreciation versus Section 179 is because when you have a loss, you can't take Section 179 deduction. So someone with a lot of expenses already might prefer to take the bonus depreciation versus the Section 179. So in the old law, it used to be the maximum you allowed was 500,000, but now you're allowed $1 million. That's a lot of asset purchase in 1 year. This is phased out when your investment in property starts to exceed 2.5 million. So when you spend a lot on property, then it begins to phase out. With Section 179, you can also use it on assets that are new or used. So it used to be with bonus depreciation, remember I said it used to be for only new assets. So people who bought used assets had to use Section 179, but now bonus depreciation offers both. So in that area, they don't defer anymore. So you might actually see more people moving towards the bonus depreciation versus the 179 just because of the less limitations. And also the new law also expands Section 179 to include tangible property used for lodging and improvements made to non-residential real property, as long as improvements are placed in service after the date of the building was first placed in service. So this law is applicable to tax years beginning after December 31, 2017. Now let's do some math in Excel to see when it makes sense to do the depreciation over the number of years versus taking the Section 179 minus bonus depreciation. So let's make the assumption that this taxpayer net taxable income is $60,000. And at this taxable income, they have the 15% tax rate. Now, if they expect their income to grow at a very high rate, where their tax rate jumps the next year, then taking the regular depreciation will make sense. Because that way, when they have bigger expenses, they can take it away out of their more higher taxable income. So that saves them money. Versus, like, let's say here, they weren't able to take the depreciation because they took all the Section 179. Everything was all taken in 1 year. So let's see, they got 4 assets and they took all the depreciation in 1 year. So you can see how their tax rate keeps going down, when they take that, because their taxable income goes down and their tax goes down. So at a 15% rate, you can see how taxes are going down when they're taking less depreciation. At the same time that they save more money in the first year, the second year they get to pay 21% on all of their net income because they've taken all the depreciation in the prior year. So the income grew from 60,000 to 78,000, which is 30%. So now let's see what happens if they chose not to take the Section of 179 or bonus depreciation. So you can see here they paid more taxes here, but they're also paying less taxes here. And this less tax is actually more because this is less taxes paid based on a higher tax rate. So when you're dealing with depreciation to figure out, should I take the bonus or should I take the section 179, or should I depreciate over time? You want to stop to think to see if your income is going to grow over time, because if it's going to grow over time, you're better off just go ahead and taking it year by year because you save more money over the years. Or if you're going to make a loss, it just makes sense to take depreciation, because with the section 179 anyway, you can't take it below loss. And what's the point of taking your depreciation faster when there's really no expenses, there's no really income that you can to write off? That makes no sense. Now let us look at the return of investment before you run out and buy assets because you can take all this depreciation or section 179 and bonus depreciation. Like, woohoo, I have $1 million I can deduct from my taxes. I would like you to pause, stop, and think for a second. Just because you have a tax benefit does not mean you have to run out to take advantage of it, because over the long run, it might not be what is best for you. One of the things you want to do when you're buying an asset is to estimate your return of investment. Because when you buy an asset, you're making a large purchase. That's money you will have to take a loan for, or even if you're using your equity to buy the asset, that's cash that's going out of your business. So you want to make sure you sit down and think about either one, the projected tax savings you will get from this assets, or two, the increase in revenue. For example, let's say I'm buying an efficiency machine and maybe I'm in a printing business. My old machine was printing like 100 cards a minute, 100 cards an hour. And then with this new machine, I can print like 600 cards an hour with half the labor. Well, I can compute my tax savings on that because one, I'm more than doubling my production. I'm reducing my labor costs. So I have to compute my tax, my savings, my cost savings. So let's say my cost savings, like my increase in revenue, because I already have, like right now, I'm so backed up. My customers are like, we need cards. It's almost Christmas time. Get us some cards. So I know I can sell this cards. It's not like I'm going to have extra capacity. I'm going to sell this card. So I know that by buying this machine, my revenue could increase by $100,000. And at the same time, my revenues increased by $100,000. One of my employees was going to leave anyway. So once they leave, I don't have to replace them. I was paying them $20,000. So that's plus $20,000. So this machine, in the first year alone, that's $20,000. I know I can make $120,000 when I buy this machine. Now this machine cost me $1 million. The bank has already told me they'll give me a loan for 8%, which is fine. I'm like, that's cool. You know, I know like over the next 5 years, at least I will make $120,000. So now let me compute what my return on investment is. To do these, I'm going to compute two rates. Well, the first one will be the net present value. The net present value is the today's value of future stream of income. So in other words, this $120,000 over the next 5 years and this $1 million today, the net present value of that over the next 5 years will be, in this case, negative 482,000. So I'm losing money. So the value of this cash flow when you account for the time value of money is negative $482,000. So this investment is obviously a bad one. The internal rate of return is negative 15%. The internal rate of return is what makes the net present value zero. So which means I'm losing 15%, approximately about 15% on this investment. So it's obviously not a good deal for me. So let's say the asset costs $500,000, half that. At that, I do have an internal rate of return of 6%, but the bank said they're going to give me an interest of 8%. So I'm losing money. My net present value of all this cash flow is negative 19,328. So even at $500,000, that asset is still not good. To get to zero net present value, to break even, I need to have at least a 6% interest rate. So when I begin, for this investment to make sense, I have to go lower than 6%. So in other words, my interest rate has to be lower than 6% because My break-even rate is 6%. So if my break-even rate is 6%, if I get a loan, anything above that 6%, I'm losing money. So if the bank can give me 4%, I mean, we can see this investment begins to make sense based on the rate of return. So the point I'm trying to make here is do not run out and buy an asset just to get a deduction. Make sure the asset makes sense. Yes, because it's very easy for you to see, look on the internet, have a salesperson come to you and promise you the world of what this is going to do. And you have to stop and think, well, for the volume I'm doing, does it make sense? What is my return on investment? What's my net present value? What's my internal rate of return? How much interest rate will it make sense for me to go ahead and buy this asset? Because even though it might save you, increase your volume and save you cost, but the truth is you might not even be at a level where you can actually benefit from the savings. So you're actually losing money and spending more. And then it looks like what it seems like should have increased your cash flow actually decreases your cash flow. So just be careful. That's the point I'm trying to make. Be careful. You can get the free lessons and free templates by going to Bizexceltemplate.com. Like what you see? Go ahead and click the subscribe button on the very bottom of this video. I look forward to seeing you in future videos.